Welcome to the March to a Million podcast with Greg DuPont, founder of the Wealth Solutions Network. In this podcast, Greg shares his journey to positively impact 1 million lives by creating an army of financially minded attorneys who embrace an expanded role in their clients' lives. Greg and his guests challenge the status quo in the legal profession and the financial services industry, and show attorneys how they can improve their lives, provide greater value to their clients, and experience greater professional satisfaction. Join us in this movement and strengthen your business by learning how to solve your clients' most pressing financial problems.
Hello and welcome to another March to a Million podcast with your host, Greg DuPont. Today we're going to talk about, what we're going to do is we're going to answer a big question. Are you investing in the 21st century, or are you still investing like it's the 20th century? Okay, Greg, where do we begin with this?
Well, we got to begin by acknowledging what's happening at the day that we record this. Today, as we record this, polls are open. We'll see what happens over the next 24 hours. And by the time this podcast is actually released, going to be a new world on the horizon, one way or the other, isn't there? And throughout the course of the year, lots of clients have asked me, friends have asked me, hey, what's going to happen with the election in the markets? And most of the time when they ask me that question, I basically tell them the markets are going to do what the market's going to do. It doesn't matter what party is in control. It really is a prime example of the fallacy of average rates of return. You can skew those numbers that depending upon X day and Y day, things are better if Republicans take over, or things are better if Democrats take over. And as we've used our to-be ex-president's term lovingly in this podcast, it's all a bunch of malarkey. And what I wanted to talk about today in that context is, the market itself has changed so much over the last 2-3 decades that all the old rules really may not apply in the future.
Absolutely. I mean, there's so many factors of all of this. The new offerings, the new kind of reality that we live in from a tech perspective, the new political climate, the new debt climate. I mean, there's so many different things that go into all of this. And I think I've said this to you on the show before, but you can't market like it's the 1900s, like when you and I were born. My children love to remind me I was born in the 1900s. So there are a lot of different ways that we could go with this. Where do you want to go with this 21st century idea? So what are the things that you're paying attention to as a financial services professional that you think that the WSN members really need to pay attention to today and in the future?
So what I want to talk about today specifically is the structure of the market. And why am I talking about the structure of the market? Because most consumer investors are still investing based upon the structure of the market in the 1960s through the modern portfolio theory. And the lessons of the 70s into the 80s, where they realized statistically that money managers seldom outperformed indexes. And so that moved the consumer towards more indexed investing and more passive investing. But here's what they have not recognized, and this is what the future holds. What they've not recognized is the structural change of the domestic equities market, which has changed tremendously. If you go back to, I think it was early 1990s, I can't remember exactly when the stock market went from fractions to decimals, but that was a major structural change to the market. And around the same time, we had the build up to 2000 and the dot-com era, and the response to it in the regulatory environment. And I was reminded of this last week when I was reading one of those publications that most consumers don't read, and that's Barron's, because it's for the investing class. And I need to give credit where credit's due. And this is an article from Barron's, October 28, Sloan's View. And the title of it, for anybody who wants to go looking for this, the market's new high isn't the only record being set. And I'll go into this a little bit. He states, at market closed on October 18, the FT Wilshire 5000 total market index reached its highest value ever, 58.76 trillion, while the number of stocks in the Wilshire was down to 3,326. That's the lowest number of stocks in the index since it was created in 1974. So that index is supposed to represent the universe of publicly traded stocks. And if we look at it, at the end of 74, why the name of the Wilshire 5000? Well, at that point, there were 4,700 stocks in it. Okay. And as we go forward, as we watched the buildup, the 401k generation starting to throw the money in the pool, if we look at the growth through the 90s with IPOs, pets.com, all of those things, it hit its high water mark of 7,378 stocks on March 31 of 1998. So at that point in time, there were 7,400 publicly traded companies in the US. And now when you think about what's happened with the collapse, now we have, what I said, the number was down to 3,326, so less than half. And the valuation of those so much higher. So what's happened is the wealth of the investor is concentrated in fewer companies. And that's reflected in things like the PE ratios, which are completely out of whack with historical norms. Because what's happened during the last 2 decades? Money has been printed, money has been printed, money has been printed. Money needs to find a place to go. And so the typical consumer, that's where their money has been going predominantly into publicly traded stocks. So we've had this artificial lifting of all boats, artificial rising tide lifting all boats, that when we look at the combination of index investing and buy and hold, puts the consumer at tremendous risk of what happens when the tide goes out.
Well, the concentration is also a really big thing that I want to focus on because it is going to be wildly applicable to some of the other things we're going to talk about today. But if you look at what has been the big market movers, right, it's like 10 stocks, man. And so talk about inflating values and inflating the values of the market, inflating the values of diversification when it comes to, modern portfolio. I think it's funny that I still call it modern portfolio, but whatever, because that's not modern at all. That's what, 60 years ago when that was created. But the overall idea that I want to drive home and have you drive home is because things are so out of whack, right? Really, from a mathematical perspective, where can people go? There are other opportunities here for investors to invest differently. What do you think about that?
So as you know, Matt, from our conversations, I'm a big believer in Tony Robbins. I went to his business mastery program last year, and in his most recent book, The Holy Grail of Investing, which is, he just ghostwrites it. The people that really the brains are writing it, but it opens up the doors in stark terms as to where the wealthy are putting their money. And I believe that as true fiduciaries, WSN attorneys and advisors and our methods allow people access to a broader class of investing for people that are accredited, right? They have certain investing norms, but what's happened is private equity has now come in to fill that gap. When we talked about pets.com, that was because the regulatory environment made it easier to take a company public. Now we can debate the value of that. There were things that were being sold that had no business being sold in terms of companies, but at least there was an engine that was out there to do that. And then in the absence of the regulatory environment that promoted that, money needs to find a place for return. And so the moneyed class has turned toward private equity, private debt, commodity investing, arts, those kind of things, right? And the beautiful thing is that on the horizon is greater access to some of that stuff. And I want to make some points here, and I'm going to quote from Robbins' Holy Grail of Investing. The appetite for alternative investments in the areas of private equity, private real estate, and private credit seem insatiable. According to research from the research firm Preqin, in 2006, approximately $1 trillion was being managed by private equity managers. Today, there's more than $6 trillion allocated to private equity, with projections that the market will grow to more than $14 trillion by 2025. So the point of this is we, as I'll call us middle class investors, we are the ones that are going to get left holding the bag when the market realizes, when the tide goes out and the publicly traded companies revert to the mean, which is a phrase commonly used in investing, to what their true value is in terms of the price earnings. Meanwhile, people that have taken and put some of their portfolio into private equity investment, private debt investment. I was recently at our annual Ed Slott Elite IRA Advisors Convention, and I was talking to somebody there that was a vendor for a private debt fund available on platforms for investors that he went into great detail about how they were doing everything, and I can't say anything about the company itself because of regulations, but they had a regular return in excess of 8%. And because the private debt market is also responded to what's happened for the last few years, when the interest rates were so low, money, meaning people with money, couldn't get return on investments in bonds and such. So they went to private lending. They funded private lending so they could get a greater return. And these type of funds are also available to the consumer when they have a true fiduciary that is working with them, as opposed to their 401k providers.
I need you to do some definitions here because I think you're taking for granted your level of experience in education, and I'm saying that in a very nice way. Can you please define what private debt is? Explain the core definition of what that means.
Yeah, so so we have debt that is government debt, right? Investing in U.S. government bonds, what have you. We have commercial debt, which is investing in the bonds of a company, big company. And what private debt is this is a functionality that has grown where people with money create lending pools to lend directly to consumers, to business, to real estate investors, those type of things. And because they basically are eliminating the middleman of the bank, they're taking the risk. So these investments are not for everybody, right? But they're taking the risk of default. But because of that, then there's greater return on investment. We can't recall exactly what episode it was, but earlier on, we had one of my friends on that was investing in real estate, private real estate investment, putting together syndicates to take pooling consumers' money and putting it into opportunities to buy real estate. So it's the same type of market that these are all coming because of, on the lending side, the low interest rate environment that existed for so long that forced this to happen, and some would say the amount of regulation on the lending exercise itself. So private debt, and that's the context that I'm using for that. Does that make sense, Matt?
It does make sense. And so in the market right now, is this something the general public can purchase shares in these private debt companies, or do they have to go through a licensed person like you?
To my understanding, if you want to go and look deep enough, you can find access to these. And some of them are available on publicly traded platforms through ticker symbols. There also are things like Robinhood, right? There access to some of this stuff through there. If we talk about the old penny stocks type of thing, those are other places where people can go and look for opportunity that's outside of this reducing index in the universe of publicly traded companies.
So where is this fit? So thank you for saying that, but I'm assuming that the listeners and the WSN members are going to realize that that's a really dumb thing to do, because there has to be everything that you have in your portfolio should be there for a reason. What are some of the reasons why you would do something like private debt instead of doing bonds or other less aggressive, volatile investments?
So once you've got your core investment taken care of, again, these are with people that have, they are accredited investors. They have more than $250,000 of income or $1 million of equity. So we're looking for a hedge against what's going on in the economy. Okay. And so we build a little portfolio off to the side, depending upon the client, how much of it's going to go into this. That is for 10, 15 years down the road. That little satellite portfolio, as it were, has things like these private equity, private debt, Bitcoin, that type of stuff in it, because we're trying to figure out how do we get to the other side of this great chasm that is going to happen when the tide goes out, what's left behind, and that's why on the more conservative end of that spectrum, we do the same type of thing with the fixed indexed annuities to build that bridge to the other side. But if we're looking at a future where the uncertainty and the hyperinflation comes into kick into play, then we want to be able to provide some return on investment, and that's how we fit that in.
Gotcha. Well, you just brought up the last topic that I think you wanted to chat about today, which would be crypto. What do you got about crypto? How deep are you involved in this? What do you think about it? Let's go there.
Yeah, I am evolving on my view of that. I was a definite anti-crypto guy for a while, but I'm changing on that. And the reason I'm changing on that is basically when it became available, publicly traded on the spot market. And we can now get an ETF that gives us some of the benefits of a crypto investment without the shenanigans that were out there and the downside risk that's out there when you've got private ownership. What a fiduciary cannot ignore is the potential for return that has, and the risk, right? And so it's definitely not a good investment for short term, and it's something that structurally is more of a limited commodity, at least when we talk about Bitcoin, than gold. Now, it wasn't for the history, but there's stuff that's well beyond my pay grade and well beyond our conversation here today that limits the amount of Bitcoin that can be produced. And it is, for many intelligent people, the currency of the next economy. And that means that the demand is going to be greater than the supply. And that means that over time, that is going to go up. And so that now has a place in the portfolio for people that are now looking for, okay, I don't really like the protection of annuities, don't like that approach, but I'm looking for a way to get to the other side of this market correction. And what are going to be the winners coming out the other side? Well, that's a good bet that's going to be one of the winners coming out the other side.
Got it. So an estate planning attorney is sitting across from a couple, and they're positioning themselves as, a WSN member, right? And somebody's going to be able to help these people with more than just their estate plan. What are some of the talking points? What are some of the things that you want WSN members to say and do to open up these conversations and see what availability there is for opportunity?
Well, the first question always is, does your money support your life the way you want to live it right now? And how do we need to change that? Okay, if we're on track, then okay, do you have projections as to whether your money is going to support your life the way you want it in the future? Okay, let's talk a little bit more about that. How does that work? How does that look? And if there is certainty, then great. But is that certainty warranted? Have they stress tested what they've got, or are they just taking the word of their 401k provider that has basically got them all sitting in the pretty pie chart that has got no protection against what's going to happen? Does the client believe that something like that is likely to happen? Well, if they're educated about it, then they recognize that it's inevitable that there's something like this that's going to happen. It's not a matter of if, it's when and what magnitude. And do they have the ability to withstand that? If they do have the ability to withstand it, then more power to them. How do we want to deal with that? If they don't have the ability to withstand it, do they want to have a plan to withstand it? How do we do that? What do we do to make sure we build that bridge to the other side? And that's a pretty meaty conversation right there.
Yeah, it's super meaty. I love that. That's going to give everybody a lot to talk about. And more importantly, people taking the chance or the time to really review what they already have. All right. If somebody wants to know more about WSN or get involved or whatever, where do they go? What do you want them to do?
Well, I'm on LinkedIn. They can follow me there, and they can always reach out to me directly through there. And the best place to find out more about WSN and the programs we offer is by going to www.joinwsn.com. That's www.joinwsn.com.
Greg, thank you very much for this insight. Everybody, you have to change with the times. It's not the 1900s anymore. We really, truly do live in a new era, not just a new era on what's going on from the investing standpoint, but also what you can do as an estate planning attorney to truly be that family's full advisor. And if you want to know more, just like he said, go to joinwsn.com, follow Greg on LinkedIn. He does respond to his DMs. I can attest to that. And so if you have any questions, just make sure you reach out. So for Greg and Matt here, we'll see you on the other side of the mic very soon.
Thank you for listening to the March to a Million podcast. Click the follow button to be notified when new episodes become available, and get in touch with our team by visiting our website at www.wealthsolutionsgroup.biz or give us a call at 614-432-8065. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Wealth Solutions Network. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice from qualified financial service providers with any questions you may have.